Hello, this is Elizabeth Pluswick, and today we are going to do an example of depreciation and how it affects cash flows that are needed for computing net present value, payback, internal rate of return, return on investment, any of those kind of capital budgeting tools that you often use as an engineer. We need to take depreciation and income tax into account to get a better estimate of the cash flows. So let's take a look at a problem here. Bell Manufacturing is considering buying a new labeling machine. The equipment has a initial cost of $180,000. That's important. And has a 5-year useful life, so N will be 5. Expected salvage value is $20,000. And tax regulations permit the following depreciation schedule. Oh, there's a key word, tax regulations. So I'm thinking that's modified acres method because it's the tax regulations. And here's a percent deductible. So I know that under the modified acres, I simply take the asset cost here, $180,000, and multiply it by the appropriate percentage to get depreciation expense for each and every year. So 180,000 cost times 20% in year 1, my depreciation expense is $23,600 in year 1. And I would take this, just follow the schedule here. In year 2, it's also $180,000 times 32% to get year 2 depreciation expense. This is year 1. And go on down like that. Remember, ignore salvage value when you're using modified acres. Okay, so we have a handle there on our depreciation expense. Let's see how that affects the operating cash flows on an after-tax basis for this company. So we can get an even better handle of cash flows for our capital budgeting tools. Okay, a little bit more information here. The company's tax rate, their corporate tax rate, is 30%, and its cost of capital is 4%. We're going to use that for our I to discount the future value of the cash flows back to today. So that's our I. Tax rate is 30%. All right, continuing on. The equipment is expected to generate the following cash savings. Oh, savings, that sounds like an inflow. And cash expenses. Okay, everything so far is dealing with cash, so that is good. Note that depreciation expense is not cash. Depreciation expense, remember, is an allocation of the cost of the asset over time. The company does not write a check for $23,600. They do not. Depreciation expense is not cash. Purchasing the machine initially is a cash outflow, or if the company takes a loan and then pays off the loan, but we're not concerned with that part of it right now. What's going to happen each year, we're looking at the 5 years here, is we do have cash savings from running this machine. We have cash expenses. And then we also have this non-cash thing called depreciation. So that's what I'm going to show you how to handle that along with income taxes on this problem. So in year 1, what we need to do is figure out net cash flow in each year. So I'm going to go ahead and do year 1 all the way through this for you, and you can continue on with years 2 through 5. So year 1, we have cash savings. So that is negative expense, right? Expense we don't have. So we count that as a positive, as if it were a cash inflow, as if it were revenue. That's a plus. Minus cash expenses. We must have supplies, labor, maintenance, oil, whatever, oil changes to run this machine. So cash expenses each in year 1 of $18,000. So we're net, so far we have net cash savings of $104,000. Now I'm going to just compute that onto this schedule, and I would continue down years 2 through 5, get the net cash savings. Here it's inflow because savings are greater than expenses. So let's call that net cash in, and on our timeline that would be an up arrow signifying cash in on our timeline, right? You do that for the other years. I have a separate schedule here that helps in computing the depreciation and the tax effects. So I'm going to go over and use this other little worksheet. And basically what we do is create a little income statement showing relative or relevant cash flows from the project for each year. So we had just computed that we have cash savings of $122,000. Cash inflows, actually that was cash savings, so the 122 should be on that line. If there was actual cash inflow, it doesn't matter, they're all adding. Cash inflows or cost savings are both positives. Subtract out cash outflows or expenses, those were cash from in our problem, we had that. And then the next thing then is to subtract out depreciation expense. We just computed depreciation expense here under modified acres in year 1 of 23.6. So I'm going to go ahead and, even though it's not a cash outflow, I'm going to subtract it here. And the reason is I'm trying to get to what the heck is my taxable income. So do subtract depreciation expense and get down to net income from this company in year 1 before corporate income tax. Then we go ahead and compute corporate income tax. And how you do that is you have taxable income of $80,400 and multiply it by the company's marginal corporate tax rate. The problem told us that was a 30% tax rate. So we multiply that and get tax of $24,120. Now we want to subtract that because that is an outflow. That is an actual cash outflow. You write out a check to the IRS for income tax, right? So that is a cash outflow, subtract it. The brackets here is another way of signifying subtraction. So I could also have put just a minus sign. Subtract tax and we get to $56,280. Now that's pretty close to the actual cash in for this company for year 1, but not quite because we had this depreciation expense. That's not cash. So we still have to add that back. So whatever you subtracted here as depreciation expense, add it back in to your net income after tax, add that depreciation expense back in, and what you're left with then here is cash flows after income tax, CFAT, cash flows after tax, from the project. So this project actually generated $79,000 of cash savings or inflow after depreciation expense is calculated and after income tax is calculated and paid. That project still results in almost $80,000 of net cash in from year 1. So that then is the number that you use, the appropriate amount to use for the rest of your capital budgeting calculations. For instance, net present value, profitability index, benefit cost analysis, EUAC, internal rate of return, any of those kind of present value discounting calculations. Any of these, you want the cash flow after income tax. And in order to get the right tax, you need to compute depreciation. Right, so that's why we go through this little income statement to get the actual cash in, cash out, compute tax correctly because we subtracted out depreciation expense correctly. So we got our tax to be right, that's cash out. Then we add back depreciation expense, it's a non-cash expense. We only subtracted it so we could get income tax right. So add depreciation expense back in, and there's your actual after-tax cash flows from the project for that year. That's the number to use in the rest of your capital budgeting calculations. Thank you.